Chapter 13, Trading or Investing. Trading and investing are two different approaches to reach a common goal. Every person who invests in the stock market has one goal in mind: to convert his or her current pile of capital into a bigger pile and generate some income in the process. I personally differ from the more common separation of trading and investing based on the length of time. It is commonly believed that short-term holdings are trading activities and long-term holdings are investing. In my opinion, when a person buys a capital asset with the hope to sell it to another person at a higher price sometime in the future, it is a trading activity, regardless of the time frame. It could be a microsecond or a period of 10 years. If the primary driver of obtaining the asset is the price and the decision to sell is based on price, the whole activity is trading. On the other hand, if the primary drivers of obtaining an asset are based on economic assumptions like growth possibilities, value measures, and return on capital invested, and the investment is meant to be held until those economic assumptions hold, then it is an investing activity. I intentionally did not include risk parameters in differentiating economic assumptions, as I believe neither investing nor trading should be done without considering risk parameters. It is a common factor between sensible trading and investing. Trading. The game of speculation is the most uniformly fascinating game in the world, but it is not a game for the stupid, the mentally lazy, the person of inferior emotional balance, or the get-rich-quick adventurer. They will die poor. Jesse Livermore. Trading as a business or an economic activity is defined by two acts: buying and selling. Buying without the intention of selling is not trading. If a stock buyer does not intend to sell it in the future, this act cannot be defined as trading. Intention to sell in the future at a higher price is the key to define trading. There are multiple forms of stock trading, ranging from high-frequency trading, HFT, to multi-year holdings. All of these forms have one thing in common: all are primarily based on price action rather than economic assumptions. High-frequency trading. High-frequency trading, or HFT, is, as the name suggests, trading stocks with extremely high frequency. Computers execute these trades with the help of algorithms explicitly written for HFTs. It is estimated that machines execute nowadays about 70 to 80% of all trades. Power machines are installed as close as possible to stock exchanges to reduce the time between orders and execution. Highly sophisticated algorithms are written to compete with other HFT software. It is an expensive business and out of reach of any retail trader. Orders are made and executed or canceled within microseconds. Profit per trade is generally small, but given the time and speed, millions of dollars can be made in a day through HFT. Thousands of HFT firms are engaged in a constant battle of beating each other. These firms are investing vast amounts of money to be faster and better than other firms. Prospects of enormous gains have given rise to activities that are either illegal or touching the boundaries of illegality, like forward running, order stuffing, spoofing, and many others. Supporters and advocates of HFT argue that HFT is beneficial for the overall market as it provides liquidity to the market. Exchanges recognize this benefit and offer liquidity rebates to HFT firms. Another advantage of HFT is the overall reduction of bid-ask spread due to improved liquidity, which is highly beneficial for retail investors. However, opponents of HFT disagree with the liquidity argument. They claim that HFT is only possible in highly liquid markets, and as soon as liquidity dries up, HFT operators pull back. They are not obligated to provide liquidity, so when it is disadvantageous for them to operate, they don't. Another argument against HFT is their behavior towards retail traders. HFT firms make money because they have access to order flow and the ability to act faster than retail traders. Every penny they make is coming out of the pockets of retail investors. The biggest argument against HFT is its instability. HFTs make millions of trades in a very short period of time. Sometimes these algorithms are engaged in a feedback loop with other HFTs and cause a flash crash. On May 6, 2010, at 2:32 p.m., HFTs engaged in a feedback loop, and the market dropped about 9% within minutes. Stocks were traded at ridiculously low prices. However, within the next 20 minutes, the market regained most of its losses and traded regularly. This is not the only incident of a flash crash. Throughout the world, multiple incidents have happened of similar nature. Spread trading by market makers. Large institutional players who are highly active in the market act as market makers. They always offer two prices: a bid price that they are willing to pay for a security, and an ask price that they are ready to accept for the same security. Ask price is always higher than the bid. The difference is called the bid-ask spread. These institutions make simultaneous trades of buy and sell and take advantage of the spread. Liquid securities have shallow spreads rather than illiquid ones. Another factor that impacts spread is market volatility. During volatile times, spread widens, and during low volatility, spread comes back to more acceptable levels. Taking advantage of spread is a highly profitable business, but generally out of reach for retail traders. Without massive liquidity as a backup, this activity can lead to enormous losses and can be fatal for a retail trader. Arbitrage trading. Arbitrage trading is taking advantage of the momentary difference in a security's price among two trading platforms. In arbitrage trading, a trader simultaneously buys and sells a security in two different platforms, taking advantage of the price difference. In the old days, when trading was primarily manual and over the phone, a retail trader could identify arbitrage opportunities and take advantage. However, the computerized flow of information has made arbitrage trading for a retail trader almost impossible. Only large institutions that have access to large amounts of data and the ability to identify arbitrage opportunities within a fraction of a second can potentially take advantage. In arbitrage trading, speed is everything. Data needs to be received, analyzed, and traded, or put through a series of trades. They need to be executed in a fraction of a second, because arbitrage opportunities are extremely short-lived. Another disadvantage that a retail trader has is the liquidity required for such trades. Arbitrage opportunities are tiny per security basis. A huge volume needs to be bought and sold to make it meaningful. These volumes are generally out of reach for a retail investor. Scalping. HFT, spread trading, and arbitrage trading can be classified as different forms of scalping. From a retail trader's point of view, scalping means betting on small price moves and accumulating small profits all day long. In this trading strategy, stop losses need to be extremely shallow. Otherwise, one large loss can eliminate the profits of many successful bets. Scalping is exceedingly popular among institutional traders and retail day traders. Again, the speed of recognizing the opportunities and acting upon them is the key to success. That's why automated trading platforms are used commonly. The holding period could be from a couple of seconds to a few minutes. Day trading. The most popular strategy among retail traders is day trading. As the name suggests, holding periods are generally shorter than a day. Day traders don't carry their trades overnight, and before the market ends, they always try to sell the positions. They don't like to be exposed to overnight risk. Day trading is a challenging and exhausting activity. A trader cannot leave the screen even for a few minutes. Opportunities come and go within minutes. It is tough to make a consistent living doing day trading, but there are exceptions. Some people make good profits consistently. Most traders either make losses or go break even. Swing trading. Another popular strategy among retail investors is swing trading that can be defined as holding securities or positions across multiple days or weeks. Swing trading is the favorite method among momentum traders who bet on the momentum of a move and anticipate that a directional move will continue until it hits a natural support or resistance level. Some swing traders bet on breakout levels as they enter into a trade after the stock breaks out, either large support or resistant level. They anticipate that once major support or resistance is broken, the price should continue in the same direction for a few more days. Another way of swing trading is to enter into a position by anticipating a significant move in the future because of some expected events. An earnings report, inclusion into major indices, announcement of a product, an outcome of a legal battle are a few examples of expected events. Buying cyclical industries is another version of swing trading, although it is for a much more extended time period. In cyclical industries, traders try to buy stocks at the peak of the downtrend and sell at the peak of an uptrend. These trades could last from a few months to a few years. Whatever the anticipated length of holdings, if a trader buys based on price action and expects to sell based on future prices, I will classify this as a trading activity rather than investing. Investing. Investing is buying an asset based on economic assumptions with the intention to keep that asset until those assumptions hold true. I deliberately did not use the word fundamental analysis. There are two reasons. The first reason is that fundamental analysis is a subset of larger economic assumptions. Fundamental analysis is more on the micro level, but an investor can and should use macro level assumptions as well. The second reason is that an investor can also use technical analysis as buying opportunities. Using technical analysis doesn't convert an investor into a trader. It is the basis of deciding what to buy and the intention to hold that defines investing. The decision of when to buy can be based on technical analysis. All intelligent investing is value investing, acquiring more that you are paying for. You must value the business in order to value the stock. Charlie Munger. There are two major schools of thought in the investment world. The first is value investing, and the second is growth investing. Both investment styles are focused on intelligent stock picking. However, thanks to the late John Bogle's lifelong efforts, we have another valid and profitable investment style, index investing. Value investing. Value investing is the discipline of buying securities at a significant discount from their current underlying values and holding them until more of their value is realized. The element of a bargain is the key to the process. Seth Klarman. Value investing, in its broader definition, is buying an asset below its intrinsic value. Benjamin Graham is often called the father of value investing. His legendary books, Security Analysis and The Intelligent Investor, are the most influential books of the 20th century. Warren Buffett and many other highly successful investors consider Benjamin Graham as their mentor. A value investor actively looks for companies being sold significantly lower than their true intrinsic value. The delta between the true value and the prevailing price is referred to as the margin of safety by Graham. The bigger the delta, the better the deal. However, value investing critics argue that a value investor ignores future prospects and decides solely on discounts. Warren Buffett calls this approach cigar butt investing. It means that heavily discounted stocks are picked, hoping that the market will realize its error and shares can be sold at a higher price in the future. It is called cigar butt investing because, like thrown away cigars, these companies may have left a puff or two. An investor can pick these cigar butts from the street, have the last puff, and start looking for another one. I have serious hesitation in categorizing this as an investment. In my opinion, it is a trading activity because both buying and selling decisions are fundamentally based on price. Warren Buffett has admitted practicing the cigar butt investing approach, but categorizes it as a faulty investment strategy and counts it as a mistake of his early investment days. In its pure theoretical terms, a value investor only focuses on the discount between intrinsic value and price and pays no attention to the investment's future. However, you cannot find any notable investor who does not look at the investment's qualitative aspects. Even Benjamin Graham does not advocate keeping a blind eye on future prospects. Growth investing. Charlie Munger once said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Buffett agrees with his investment partner. It is a clear divergence from Benjamin Graham's value investing approach by his most famous student. In this investing approach, an investor starts their search by looking for wonderful businesses rather than deep discounts. Once a buy target is locked, then the investor waits for the market to offer a fair price or better. Once the fair price is available, the investor can start accumulating its investment. This investing approach is called growth investing, championed by another famous investor and writer, Philip Fisher, in his legendary book, Common Stocks and Uncommon Profits. In his book, Fisher lays out principles of finding great businesses. Warren Buffett once said that he is 85% Benjamin Graham and 15% Philip Fisher. It is important to note that Fisher never advocated investing in companies modern-day gurus consider growth companies. In their definition of a growth company, only growth of volume and revenue is essential. It doesn't matter how much loss this company is accumulating in the process. Is there any feasible route to profitability even in the distant future? If I am selling dollar bills for 75 cents, I can make many clients and make many sales, but can it be counted as growth? We have seen disastrous implications of this approach in the dot-com bubble, but hardly learned any lesson. In essence, growth investing is finding businesses where you can comfortably allocate your capital for a very long time. This approach focuses more on prospects of business, but also investigates past performances and current financial health. A growth investor must examine the quality and business approach of the management, workforce, customers, markets, and much more. Fisher even suggested talking to competitors before making any buying decision. The successful purchase of growth stocks requires two rather obvious conditions. First, that their prospect of growth be realized, and second, that the market has not already pretty well discounted these growth prospects. Benjamin Graham. Once a buying decision is made, an investor must wait for the right price or use a dollar-cost averaging approach. Fisher suggests that at the time of purchase, the best holding period is forever. If the business is excellent, why should somebody think about selling? Warren Buffett also endorsed this idea when he said, "Our favorite holding period is forever." Dividend investing. Dividend investing is an offshoot of value investing. Large corporations' stock is required at somewhat discounted prices when dividend yields are higher in this approach. An investor only counts on continuous dividend payments. As this approach is considered risky, generally, a portfolio of high-quality companies is acquired as a hedge towards one or multiple companies' failure. Growth of business or prices is not the primary concern. An investor must be careful in choosing dividend-paying companies. Shooting for high yields can be seriously damaging. A better approach is to buy only extra-large companies having multiple revenue streams. A moderate dividend yield, slightly higher than 30-year bonds, is far better than a super high dividend yield. Those yields are not higher because companies pay high dividends, but because stocks are super cheap. Generally, a cheap stock is cheap for a reason. If you don't know the reason, you will be better off investing your capital elsewhere. Dividend investing has become popular these days as a proxy of the fixed income component of a portfolio. Interest rates are in continuous decline for 30 or so years. Fixed income investors are desperate for a reasonable yield. Considering the low interest rate environment, dividend-paying stock seems to be a valid avenue for capital allocation if you do not look for a lot of growth or capital appreciation. Index investing. Index funds eliminate the risks of individual stocks, market sectors, and manager selection, leaving only stock market risk. John Bogle. The index investing approach is to invest in a basket of assets rather than trying to pick winners. These basket of assets can range from the total global stock index to very narrowly defined niche markets and everything in between. The types of assets can be real estates, fixed income securities, stocks, and many others. John Bogle, the founder of Vanguard, is considered the father of index investing. Index investing in its pure form is buying a mutual fund or ETF, replicating a broad market index. Broader is better. The advantage of this approach is the guarantee of achieving market results plus instant diversification. However, you can find all sorts of mutual funds like semiconductors or financial services, or 3D printing. With the rise of ETFs, the market is full of exotic and extremely narrowly defined investment strategies, wrapped in an ETF bundle. People are exceedingly using ETFs as the proxy for stocks in short-term trading. We will discuss index investing in detail in the next chapter. Difference between trading and investing. Following is a side-by-side comparison of trading and investing. I tried to write this from a neutral point of view, but as I am primarily a long-term investor, my analysis is somewhat biased in favor of investing. In my opinion, a trader needs to be highly skilled and extremely lucky to beat the market consistently. If a trader is highly skilled but not lucky enough, or extremely lucky but modestly skilled, he will beat the market occasionally but not consistently. Traders that are modestly skilled and modestly lucky will briefly beat the market but will be behind the market most of the time. Everybody else will lose money on a long-term basis, that is, 90% of the traders. I don't know how accurate or skewed this 90% estimate is, but it is consistently mentioned by advocates of trading. Let's assume this estimate of 90% traders losing money and only 1% beat the market is correct. This means a trader has only a 1 in 100 chance of beating the market if it is only a game of chance. The chance of making the 1% market-beating team in 2 consecutive years is 1 in 10,000. The chances of beating the market for 10 straight years are astronomically high. I don't want to put that number here. Let's say it is very close to 0. Jim Simons and his Medallion Fund come to mind when we talk about exceptional performance by a trading fund. Despite its extraordinary performance, Medallion funds fell behind the S&P 500 a couple of times. If you look at the performance chart, you will realize that all outsized gains were achieved in years where the market was extremely volatile, and there was a massive meltdown. The years 1991, 2000, and 2008 are the biggest to mention. Trading. In trading, the primary driver of all decisions is usually price. Investing. In investing, primary drivers are usually economic assumptions. Trading is the anticipation of a change in price during the holding period. Investing is the anticipation of business growth over time. Trading is for the harvesting of capital gains. Investing is for capital growth. In trading, selling is an essential idea from the very beginning. In investing, selling is not considered until economic realities have changed. Generally, traders rely on technical analysis. In investing, technical analysis is used to identify a better entry point. Trading is generally short-term, ranging from microseconds to a couple of years. Investing is for the long haul. Trading relies on market volatility. Investing relies on business viability and growth. The cost of trading is high because of brokerage, spread, and slippage. The cost of investing is low because of the low number of transactions. Trading is time-consuming. Investing is much less work. Trading is exciting. Investing is boring. Trading is physically and emotionally exhausting. Investing is challenging, but not exhausting. Trading is a zero-sum game or a minus-sum game after deducting transaction and research costs. Investing is about the growth of value. Most traders lose money. Most investors make money. A small number of traders beat the market, and even fewer do it consistently. A fair number of investors beat the market, and an even larger number beat the market on a long-term basis. Trading satisfies the need to do something to make money. Investing, especially passive investing, does not fulfill the human need of constantly doing something. Trading is fast-paced. Investing is acting with patience. Trading is inherently risky. Investing is safer. Trading is tax inefficient. Investing is tax efficient. Retail traders have disadvantages over professional traders. Retail investors have significant advantages over money managers. Government policies try to reduce the lifeblood of trading, volatility. Government policies work in favor of long-term investors. Hybrid approach. Most of the long-term investors, including myself, engage in trading activities a little. On the other hand, almost all traders keep a long-term portfolio that they don't want to touch. It is sensible for both investors and traders to dip their feet a little in unfamiliar waters too. For a long-term investor, a little trading satisfies their animal instinct of beating the market. In addition, some trading keeps them engaged in short-term market activities. It also serves as a reminder that long-term investing is a better method. For an active trader, keeping a long-term portfolio is the most sensible thing they can do. First, it acts as an insurance policy. If they blow their trading account, they don't lose everything. Secondly, a long-term portfolio provides a benchmark for their trading activities. Chapter takeaways. Trading is buying and selling to exploit a change in the price. Investing is acquiring assets for economic reasons. Government policies generally are in favor of long-term investing and are against short-term trading. A tiny percentage of traders beat the market over the long haul. Conversely, most long-term investors make money and beat average returns. Trading satisfies a human psychological need to do something to earn. It gives us an illusion of control. It is a good idea to have a small trading account to satisfy this psychological need.